No hype, no shilling. Pure signals straight from the experts. This is the big picture. GM everyone, welcome back to the big picture where we unpack, as you know, the intersection of crypto, of macro, of politics, and of course, the capital flows that most of CT ignores. Now, Mr. Thomas Bahamas is back in the chair this week with me. TB, welcome back, sir. How you doing?
Everything that happened in April, May's shaping up to be a pretty good month so far. I took a vacation last week and looks like all my coins pumped while I was gone. So things are looking up, right?
Happy days. I guess you should take more vacations in that case, but don't, because my workload increased. Now you're back. Things are indeed moving up. Just a very brief update here. BTC, ETH, Sol, ZEC, all of these were rallying. BTC, for example, over 80K, which is good news. Sol tagged $98 while you were on holiday, TB. So very close to that psychological $100 level. We love to see it. And if you sort of zoom out and try and get a sense of where BTC is, right, because it is a leading indicator, it's been trending up since that 65K bottom. Now, many people are wondering if the worst is behind us. We'll find out today if that is likely to be the case, if institutions think it's the case. But we are starting to see people calling for the beginning of potentially a new bull run. I'm really curious to see if that is going to happen. But you're right, April was horrible. It was $600 million hacked basically in a month. What looks like all North Korean state campaigns, very grim month. But something seems to be shifting behind the scenes. So I'm really, really curious what today's guest is going to make of where we were in April, where we are in May, and also what we can expect in June and July and what the institutions are thinking about.
Yeah, absolutely. And Before we can get into today, which I'm very excited about, a quick word about last week's episode because it was a really important one. So it was you and Finn, and we had the legend Mike Dudas on, and Mike doesn't hold back. If you guys follow him on Twitter, you'd know this.
He does not.
He doesn't, and he made a very specific case for why May onwards we're going to see a meaningful shift in tides, and it looks like it really kind of boiled down to three things that he kept coming back to. Did you want to kind of go into those a little bit and bring that up?
Yeah, it was an interesting conversation, as you said, but three main arguments that he made, right? The beginning of it was addressing some of this anxiety that we have on crypto Twitter. And he said it's validated by what we're seeing, which is an AI brain drain, right? The best builders from 21, 22, these guys have largely gone to AI, but it's not ubiquitous. There are very serious builders who have stayed. Now, the second part of his argument, and this one really actually stuck with me, is talking about how difficult it is in 2026 to build a breakout consumer company in crypto because, in part, due to the vertical integration that we're seeing from names like Jupiter, Phantom, Pump, you name it. And these were very, very interesting points.
Yeah. And and what he said, it's not necessarily a bad thing, right? It's almost the maturing of the industry. So now things are running a little bit differently, right? So it's interesting to get his opinion on that. And I'm excited. I really enjoyed listening to that episode. So thank you guys for that. Wish I could have been on it, but yeah, I mean, it's definitely exciting. And with the change of the market, we'll see how it progresses.
We will. It's always great chatting to Mike. Before I forget, the third point that he made, and this sort of ties in a little bit more to today's conversation, was about institutional interest accelerating. And I think to put some numbers behind what he was saying, that we've seen $6 billion in VC fundraisers just last month. Dragonfly, which is $650 million of it. We'll be talking to Hasib Qureshi from Dragonfly, managing partner, that also a hot take central. So that should be an interesting conversation. But he was talking about the problem as we see it from a CT retail participant perspective is, okay, we have this brain drain, not great. VCs are raising, that should be great, but still prices are lagging fundamentally behind the fundamentals, right? So on-chain activity is there, institutional demand is there, but the prices haven't quite caught up. And it seems like this week, or rather while you were on holiday, TB, that is changing a little bit. And I'm curious what today's guest makes of it as well.
Yeah, exactly. And so, I mean, that's going to be the main question for today, right? How is this looking from the inside of the institutional world from somebody that's literally, building the infrastructure that institutions are looking for and using to get yield on Solana? What does that demand actually look like? I think that the institutional wave that we saw, it really took off last year, right? It seems like it's definitely real. It's not going away. So I'm interested to hear all about it and, kind of see where that's going to take us.
Absolutely. Let's find out. So a little bit of an introduction to today's guest. Now, she's been working at the intersection of TradFi and crypto for years now. A very, very impressive resume. Accredited CFA, experience in derivatives, structured finance, investment banking, all the things that our listeners might find boring, but are very, very critical in the TradFi world. A background in Bank of America, Merrill Lynch, and Morgan Stanley, before, of course, making that important leap into crypto. She also ran growth at Consensus for MetaMask Institutional, co-founded Ethereum's climate platform, which is very, very impressive. And today she works at Twinstake, who provides critical infrastructure for institutional Solana staking. How much institutional Solana staking? You say, well, it's around $1 billion in SOL delegations.
Yeah, that's fantastic. What an amazing resume to look at. And so Twinstake is Europe's largest staker of ETF and ETP assets. So it's definitely exciting to have her on. And yeah, like you said, around $1 billion in SOL delegated through their validator. That's a good number, right?
It's a big number.
Yeah. So these are real allocators, putting real capital to work on chain. And Harriet sits right in the middle of it.
Absolutely. Harriet Browning, welcome to The Big Picture. Great to have you on SolanaFloor. How are you?
Hey guys, thank you for the very, very kind intro. You did a better job than I could ever do. And it's great to be here. So look forward to this conversation. And yeah, to your point, the institutions are indeed here. They're not just coming anymore. They've arrived, and we're seeing those flows. And so I'd love to dive in and get into the nitty gritty of all.
Absolutely. That's exactly where I want to start. So typically we ask our guests to sort of paint the bigger picture for us. But before we get there, I want to start with a bit of a time capsule question, because I think it really sort of paints the picture as far as, you know, where your journey started and how it sort of meandered to where we are today. So bear with me for a second while I paint this picture. Paris Blockchain Week 2022. You said, and I'm going to quote you here, Harriet, it's definitely no longer that the institutions are coming. That narrative is done. You said they're here. Back then, though, as we mentioned, it was Consensus, MetaMask, Ethereum. 4 years later, fast forward, and you're working at Twinstake, powering some of the most critical infrastructure for institutional Solana staking. We've got ETFs now with staking activated as well. And these institutions are buying and staking Sol. So clearly a huge amount has changed. But in those 4 years, what has impressed you most about Solana?
Yeah, I mean, look, I've been very fortunate in my career, right? Like, I've been fortunate that I've had this varied career sitting across TradFi, seeing what institutionals actively care about, and working in structured products and derivatives, and working with institutions who are deploying, you know, pretty complex strategies. And then, you know, you mentioned Consensus and really the genesis of my move into crypto, which was almost a decade ago now. And in those early days, the conversation in enterprise blockchain was really around kind of permissioned ecosystems, right? So there was an understanding of blockchain, but it came from very much like this permissioned background. Institutions at the time very much cared about control, you know, privacy, compliance, of course. And so the sort of idea of moving into permissionless spaces was pretty scary for them and daunting. And there was a very like primitive level of understanding as well what permissionless ecosystems meant. And I think, you know, to be fair to them at that time as well, the infrastructure was, you know, severely underdeveloped. You know, we just really started with some of the very early DeFi protocols in the Ethereum ecosystem, and Solana was, you know, very early in its journey. And so I think, you know, testament to where we are today and seeing these large institutional inflows and activity and adoption of different use cases on chain as well as off chain really signals, I think, the growth of the underlying infrastructure. And so from a Solana perspective, I think competing now in the same realm as in Ethereum back then, when Ethereum was seen as sort of the institutional platform that was leading permissionless, and now we have Solana also with a significant healthy balance of, you know, RWA activity. I think there's nearly $2 billion worth of RWA, TVL on Solana. I think it just, yeah, signifies the amount of work that's gone into upgrading and improving the underlying architecture to support those use cases. I think that's probably the most impressive stuff.
So I guess in the interest of balance then, those are all very positive developments, and we love to talk about them here on SolanaFloor as well, being very much focused on the Solana ecosystem and all the developments. But has anything blown your mind in, I guess, in a negative way over the last 4 years, spending more time with Solana teams, with the builders, you know, dealing with the sort of more degen culture that we experience here in Solana, maybe some of the language that people use? Has anything blown your mind? Anything shocked you?
I think when you come from TradFi into crypto, almost everything is shocking to begin with, right? And I think, you know, I came into the space in 2018, 19. The space was very early built by crypto natives, people who had a strong view on decentralization and had really good values, and I think wanted to build a more robust, trustless, immutable system. And I think there's a lot of frailty that existed in traditional finance. We saw this in the global financial crisis in 2008, all the systemic risks that can come from, you know, poor auditing or lack of verifiable positioning on liquidity, et cetera. And so I think the early adopters very much had a great vision, but obviously those early crypto years were also very much shaped by a lot of speculation, a lot of retail activity, and there's no problem with that. However, a lot of it was without those guardrails that, you know, now institutions need to have those specific guardrails. And so I think, you know, yes, it was shocking. A lot of the things that happened, you know, and we can talk to various blowouts and incidents that happened along the way. You know, there was nothing greater than FTX and the lack of controls that we saw at that time, for example, that led to such an impounding event. But these were early days of learning and I think development. And so over that time, I think we've just seen a more mature industry being built more lessons have been learned, and I think the infrastructure that's been built and the protections around that really reflect, I think, the change of temperature, commitment, education, awareness, and then as time goes on, I think we've seen in the last cycle, we're less reliant maybe on some retail flow and speculation and that kind of PVP extractive mechanism. And Solana had a lot of that activity, I think, along the way, as did many other blockchains. And now it's much more sort of committed, sustainable, serious capital that, to your point, I think I heard you just before I came on, it's less about the price action, more about this long-term positioning and this innovation at the technical level, and this infrastructure, and how then that can be integrated into traditional financial institutions as part of their existing tech stacks. And that was the conversation that we really started 10 years ago at Consensus and in enterprise blockchain and sort of with our pitch decks going in saying this is what a blockchain is. But it was really that sort of full cycle, and we're now seeing the value of that come through.
Absolutely. And Harriet, welcome to the show. Really glad to have you on here. I'm gonna pop in and ask you a quick question. So you brought up the early days, and they were looking for a robust, decentralized system, and that was they were very principled in the early days. From that vision in the early days until now, like, is that vision coming true from what you're seeing? Like, is what we're seeing on Solana, the ultimate vision of?
I mean, I maybe can't speak exactly to what the Solana vision was in the early days, as I was not as close to the ecosystem at that time. But maybe if I kind of zoom out a little bit and frame this context, this conversation a little bit more around, say, staking, because that's a core primitive of the on-chain stack, and obviously alongside custody has always been the backbone of digital assets. And I think it's if I tell a little bit maybe about the story of Twinstake as an example, it's pretty telling about how this industry has evolved. And so in the very early days of staking, and maybe I just touch on that a little bit more for anyone who doesn't know what staking is, staking essentially is when someone who holds native assets, such as Solana, can delegate those assets to a validator, or they can run their own validator that then has those assets delegated on it, and performs functions for the benefit of the protocol. And so that will be around the governance and the way that transactions are sourced, and then the way the transactions are executed on chain, and the consensus mechanism that governs the implementation of that. And so in return for that, the protocol pays rewards as an incentive for running that kind of operational layer. And so this is like one of the earliest parts of the crypto ecosystem as it's grown and evolved. But in those very early days, a lot of the staking facilities were either self-run, home-run validators, and that was an incredible job that a lot of people did, spinning up their own validators at home and managing the delegations there. And then some of the early service providers were really kind of tech-led and retail-first operators. And I think that signifies, like I said earlier, the kind of cycle that we were in. It was very retail-led, and so it makes sense that a lot of the early operators also leaned into that. But later on, we've obviously had this institutional layer, and that has pushed this requirement for more robust infrastructure to be built, which has a higher commitment to sort of security, because these institutions want to be able to deploy, 8- and 9-figure delegations. And so having staking infrastructure that is designed to run kind of low-value retail transactions no longer fits the bill. And so there was this requirement to essentially build a company to enable institutions to really feel confident and comfortable in deploying those assets on chain. And so that was the genesis of Twinstake. And so Twinstake is kind of uniquely positioned because we came at this market with a white piece of paper and said, if we were going to build an institutional only staking provider, what would that look like and how would we design it? And we have this wonderful history where we worked with, we were incubated by a company called WebN, which was the venture arm essentially associated with Brevin Howard. And then the other part of this joint venture was Nethermind, who are one of the most respected kind of protocol engineering firms in crypto. So from day one, we had this combination of like deep core protocol technical expertise paired with this like capital markets DNA. And that has led us to be able to sort of build this stack and infrastructure that marries those two worlds together and really facilitates delegations for multi-billion-dollar institutions. And I think we've had to therefore work very closely, with the Solana Foundation, with Solana teams, and with other teams also, partners in the ecosystem, developing the infrastructure to make sure that everything that is being done collectively is really working towards that end goal of providing increased throughput, latency, and diversification.
Fantastic. That's one of the most elegant ways I've ever heard staking described. So thank you for that. We always kind of brush over it because we're used to it at this point, right? But to actually explain it that way is I think it's incredibly valuable. So thank you for that. So now the pitch is to institutions, right? So institutions are coming to you and you guys are staking their Solana for yield. Like what is your pitch to them, or like what are they coming to you for, and what do they like most about Twinstake?
So to the point I made earlier, yeah, it's hard to differentiate in some ways in this staking world when you just look at it on a very high level without understanding the deep nuances of the operational and technical implementations that come with staking. But actually, there is quite a significant amount of differentiation between different providers and the types of service they offer. And so when people come to Twinstake, I think what they really are looking for is this kind of concierge type boutique white glove service. We work very closely, like I said, financial DNA. We've got people here from Goldman Sachs, JP Morgan, Morgan Stanley, Bank of America, Merrill Lynch, alongside those kind of nethermind engineering brains as well. So when people come to Twinstake, I think what they're looking for is this, more bespoke service and deep protocol engineering twin together. And so we have, exceptional customer service. We're very thoughtful about the implementations that we do, and we're seeing great results for our clients as well. Clients, of course, top of mind is always performance, and then beyond that, it's do you have segregation of the assets? Do you have good control over how you manage the keys or the integrations you might have with custody partners who also then hold those assets on behalf of the clients? Do you have jurisdiction differentiation? Do you have, almost like regulated-like compliant approach to the way you run your business?
Yeah, and now, okay, one more question on this. So when they're coming to you, are you pitching them on Solana? Like, are you pitching them on Sol, or are they coming to you with Sol and saying, hey, we got this Sol, we want to stake it, we understand that there's yield, and you guys have a very, very good protocol when it comes to all the safety and everything is very white glove, we want to stake it? Like, what does that look like?
Mostly, I mean, look, we cover 18 chains in total. Okay. So we're differentiated in some way from others who are sort of more hyperscalers, or they try and cover all the different chains, 50 plus chains. We're quite narrow, actually, I think, in our focus. And we cover the chains that institutions care most about. So the majors, typically, and Sol obviously being one of them. So most of our clients do hold Sol, or a lot of our clients do hold Solana natively. Mm-hmm. And so for them, it's really like, putting that to work. And then they do come to us to generate those rewards on their behalf by running those validators. Particularly, I think our kind of product market fit and our first go-to-market was really around ETPs and ETFs. And I know you gave it a nice piece in the intro there, but our first kind of foothold in the market was generating a significant amount of the ETP ETF wallet across Europe. And then we've also developed mandates in the US. And actually, we were the first crypto staking ETF out there with REX-Osprey. So we supported them, and they launched their kind of 1940s Act ETF pre the regulation for the SEC coming in, that then obviously allowed others to come and do more traditional ETF allocations. But in those early days, it was very much people looking to find the right solution for their type of business. And because of the way we built our product, it very naturally fit with ETF and ETP providers, and we built some additional features that worked really well for them. And so, through positive references, and I think also our DNA and our background and the institutional mindset that we have, we enabled a number of institutions. And then, equally, when we see things like the performance we've had over the last month on Solana, where we've been generating, I think, 6.87% APY, which is 30 basis points above network average and 20 basis points above our closest peers. We're then obviously talking to our clients very actively around this, because we're very proud of the work we do and the work that we've done to kind of create those technical upgrades and implementations in the team, and then seeing the results. And so we also talk to clients about Solana. And it would be a missed opportunity also not to talk about Solana broadly because of the amount of adoption that we're seeing from institutions and the amount of interest we're seeing. So it's very well aligned with the business that we do here.
Okay, I got one more question.
You mentioned something very, very important there a second ago, and this is part of a bigger conversation that we've been having, I think, quite frequently at this point on SolanaFloor with our guests, which is that institutions want basket-type products. We see this with ETF demand, but also you mentioned their white glove concierge type of service that they're expecting now, and I find that quite fascinating. So, sort of paint that picture for me. Let's say I walk into your office and I've got a very small $3 to $5 million that I want to sort of allocate. How does that conversation naturally sort of progress? Is it, could you please create a basket of assets for me so I can get exposure to, the big three, let's say Sol, ETH, BTC? Or is it more that here's my risk appetite, here's the amount of capital that I have, what would you recommend?
Interesting. I see the angle you're coming at it from. And maybe just to clarify, so we operate in a non-custodial, self-custodial model. So we don't actually take ownership of the assets. They would always stay coming from a custodial partner or from the wallet of the asset owner. And so we're not running this in a sort of asset management way. Typically, our clients are asset managers or ETFs or hedge funds or banks. And so they're coming with already their pre-ideas around what they are wanting to do. And then they're looking for the best solution that fits their needs. So they're saying, okay, who is going to provide us the best level of service? Who's going to provide good performance? Who's providing certainties around the execution and the infrastructure and the robustness of that they will need? And as you probably are well aware, TradFi have a lot of significant requirements when it comes to compliance and risk and how things are managed. So this is something we've seen really evolve, I think, over the last few years. Maybe in the beginning, people were much, not less sophisticated, but they were less aware, let's say, of the nuances. And so as things have evolved, they've become more conscious about the choices they're making. And
right.
so we've definitely seen that as a reason why people then come to us and want to work with specific validator partners rather than just looking at it as a plug and play or click a button and we're happy to allocate just to get.
That is an important distinction for our listeners as well. Infrastructure providers versus, let's say, wealth managers, asset allocators, very, very important distinction. So take me into one of those conversations that you've had in, let's say, the last month, as we've seen the performance of Sol as an asset do great. Your validators, you mentioned, are performing better than others. When somebody says, why Solana, what's your short answer?
So I think there's some really interesting developments that are happening on a technical level in Solana that have really come to the fore in the last couple of quarters and will do in the next few quarters. Alpenglow is a great example of this, which is a protocol upgrade that's coming later this year. Alpenglow essentially will be able to bring reduced latency. So I think we're going to see the throughput landing at like 150 millisecond settlement, and that will improve how transactions essentially propagate the network. So when you're an institutional client looking to use a network like Solana, you care about throughput, you care about finality, and also the speed at which these things can happen, as well as obviously the underlying security of the network. And you can think of how important stablecoins have become in our industry and the incredible growth we've seen in stablecoin TVL. And then you look at okay, what are the use cases? What are the use cases for stablecoin? What are the use cases for blockchains generally? And I love to think of this anecdote of making a payment, right? In a traditional world, if you were going to pay for something in a restaurant, settle your bill with a card, you can't stand and wait 20 minutes for the transaction to settle before the cashier says, okay, yeah, that transaction's gone through and you can now leave the restaurant. Now, obviously, in a real world example, that doesn't need to happen because there are these trusted systems where there are agreements between your card processor and the bank, and they can kind of settle and agree with each other off-chain, if you will. Whereas on-chain, everything has to have that throughput and finality. So, when we think of things like high-frequency trading, or even, trading very liquid instruments, there needs to be that settlement. So the Alpenglow upgrade is going to bring a lot of value, I think, from an institutional perspective. And so what we're kind of seeing, I think, with this is this evolution of Solana as an execution venue. In the very early days, it was very much kind of core protocol design. And as a staking provider, you could differentiate on performance just by having better uptime. Whereas now that's not sufficient, and you need to really think more about the development of the infrastructure and the different types of client diversity and how you're going to then implement those and optimize in order to bring more value. But it does just show the institutionalization of Solana over time, that these things have now become the considerations, and execution is the priority as opposed to just having a functional blockchain.
Yeah, 100%. I can't wait for Alpenglow myself. It's going to be exciting to see. Now, when we look at the different blockchains that you guys serve, Solana's like, what is it, 6, almost 7% yield on it, right? So there's native staking yield that is pretty high when you look at it comparatively to something like ETH, which is at 3%. Now, recently on Solana in April, we had a pretty rough month when it comes to hacks, right? I think it was over $650 million hacked just in April alone. Is that, like, are clients calling you saying like, hey, what's going on here? Are we at risk because of this yield? Is that yield a risk at all when it comes to your clients? Because I would imagine that'd probably be why they're choosing
asset activity that is being run on top of that. And clearly that's where we've then seen some of these hacks, because they're more likely attack vectors. Not to say that we are not an attack vector. Of course, every staking provider is constantly very aware of the security risk that we are running, and that's picking generic validator partners because they want to work with the ones who have the top and highest. So I don't think hacks in themselves deter. I think it comes more at the next level up, which is that implementation into sort of on-chain strategies to generate maybe additional yield or look for alternate sources of yield. And there, obviously, you have more levels of risk because you've got maybe smart contract risk, and you're also relying maybe on liquidity and other things that are sort of outside of your control. So I'd say that's probably the way I would look at it.
$600 million hacked in a month, regardless of where it is on the stack, is very much a reason to not dip my toes into it. Which one of those is more true, I suppose?
I mean, look, anything I say is obviously not financial advice and should never be considered that. And it's also, always on people to do their own research and due diligence. But I think from an institutional perspective, which is really where I can talk to and the clients that we talk to and how they think about this, like I said, they're comfortable entering into the validator operations because they can earn a 7% yield. Where sometimes they become less comfortable is engaging in DeFi, because some of those things feel a bit more remote in terms of the risk that they bring. But there are actively institutions who are looking to engage. So it's really about their ability to then model out what that risk looks like. And so we are, one example of this is we're seeing quite a lot of interest right now in LSTs, liquid stake tokens, because one of the issues for institutions in some ways having delegated their assets to a validator is that there's no liquidity around that. And so liquidity is very important in certain operations. And, we can think of some of the ETFs who are using staking in the back end where they have redemptions from end users who want to get back into cash if they've invested in the ETF. And so they need some way of going in and out of the underlying native asset. So a lot of them will then be able to use liquid stake tokens as a sort of that mechanism to then redeem to cash and then go back into the liquid stake token to kind of keep the native asset allocation at the same level within their ETF. I mean, that's probably not quite the angle that a retail person might think about, but it's totally understandable that anyone would look at a hack of 600 million and think that is a reason not to maybe dip their toe into.
Particularly when, as it has appeared over the last many years, it is state-sponsored acts of financial terrorism, if you want to call it that. But these people have very deep pockets, and your average DeFi protocol can't successfully shield themselves against these attack vectors. Having said that, I want to ask you, where do you see the most overlap between a retail participant's involvement in DeFi and some of your institutional partners' involvement in DeFi? You mentioned liquid staking there. We obviously have things like vaults and looping, and a TradFi, a person might think of how much leverage am I taking on and how do I model that risk? But where do you see that overlap? Do your institutional partners come to you and say, you know what, can we bump that up to 9% with some additional risk? Can we loop some of these funds? How do those conversations go?
Yeah, it's definitely an interesting area for, let's say, crypto native asset managers who've been in the space a long time and understand those risks well. We see a lot of these people now providing vault solutions where they will run strategies that overlay using maybe liquid stake tokens as a collateral, which they can then borrow against in stablecoin and run some sort of strategy there, or they can create some sort of market neutral strategy using perps or otherwise. And we've seen that, you know, there's been some retail interest in these additional yields. One of the questions there is always around the understanding and the knowledge of risk that is being taken for the level of yield. And I always say, you know, whenever there's yield, you have to ask where it comes from. There's no such thing as a free lunch. And so there's always that curve of risk to be considered. And so I think that should always be top of mind, you know, when considering what strategies make sense. But we are seeing more traditional asset managers also mention vaults in conversation and are interested in the space. Whether they're actively participating at this stage, it may be a bit too early, but you know, I think looking at this as a sort of on-chain asset management space, vaults obviously enable, because they're essentially, for anyone who's less familiar, there are these programmable containers that enable assets to be put to work according to a set of rules. And so you can see it very quasi-asset management-like.
That sounds good. Now, when you're talking about like risk and institutions, like, are these institutions, like, do they have a little degen side to them? Like, what is their risk appetite? Like, are they saying like, hey, like I'm getting 6% yield on this. I like Solana. It's gonna go up. Let's juice it. Like, are they coming to you with those type of questions at all, or what does that look like?
Less so coming to me on those sorts of things. You know, for us, we get people with a much more conservative view of saying, hey, we just want our assets safe and we want them staked and we want to earn protocol rewards. You know, it's less of a yield conversation. That is certainly outside of our purview, and I think there are people who are specialists in those sorts of things, and it's not something we do here. I have definitely seen an evolution though from those early days I mentioned, enterprise blockchain and explaining what is a blockchain, to now, you know, we see all the big banks and traditional asset managers hiring crypto teams, and they're hiring, you know, positions such as DeFi lead. So that I think is pretty indicative and a nice signal that we can take from the industry where things are at right now. Yeah,
so they're slowly going to be merging with the crypto degens. I like the sound of that. Now, a question I want to ask. So the prices seem like they're lagging fundamentals right now, right? You know, Mike Dudas made this big point last week, right? You know, he's looking at the on-chain data and it's fantastic. Like we track a lot of the on-chain data, and you know, we talk about it, you know, every week here, and it looks incredible. You know, stablecoin usage, like any metric that you want to look at, like, is pretty solid, other than the price at this point, right? So when you guys look at that, is that the opportunity that that you're selling or that you're talking to people about, or how do you look at the difference between those two?
Yeah.
Not financial advice. It's something, it's top of my mind, right?
It's quite funny, and I've got a lot of time for Mike, and I think he's been in the industry as long as I have, if not longer, right? He's an OG.
Yeah.
And so, you know, those are really valid comments, and I think we see a lot of on-chain activity happening. At the same time, it's hard for me to say when I see, you know, Bitcoin nearly $80,000, ETH at 2,200, and I think Sol's back near to 100. It's hard for me to say that that's disappointing, in that, you know, I remember the days when we would have dreamt of these being the outcomes. So yeah, I think there's a lot of impatience sometimes in our industry because we've seen these cycles happen. And I think we also have to be aware of the macro cycle that is the overarching cycle, and crypto is never removed from what's happening in macro space. And reality is, you know, we're seeing, you know, I always look back to like, what's the 10-year yield doing on US Treasuries, and ultimately capital's more expensive than it was 3, 4, 5 years ago. And so that dictates a lot of what allocation looks like. And then, you know, to the point we were talking about institutions care less about price. They care less about this as part of their adoption curve, because what they're building is infrastructure and they're building technology. And so to me, the signal is who's building, what are they building, and how much investment is being made from a operational perspective into this space. And then what happens to price, I think, is going to be a sort of pass through of some of that activity, but it's never going to be removed from global macro. And I think the global macro environment is more and more challenging to predict at this point. So I think we're sort of in this wait and see phase.
Harriet, it sounds like we're not going to get a SOL to $2,500 a pop price target from you anytime soon, which is probably good for our audience. But we have heard that from some of our guests in the past. Anthony Scaramucci, who we love talking to, famously said that very, very soon, well, on a 5 to 10 year time horizon, but nevertheless, very, very soon, we will likely see SOL at $2,500. Sounds like we're not going to get that from you, but you said macro there. We do like talking about the macro reality because day to day, it seems to be getting more and more complex. You've got the Clarity Act seemingly hanging in the balance, but progress is being made in the last 24 hours. Very exciting. Nevertheless, as retail participants, we are very anxious about the Clarity Act. I'm curious if institutions and TradFi participants also see that as the main bottleneck that's sort of holding price back, regardless of all the fundamental conversations that we've had. And is this something that you feel both with your American partners and in the UK, or is it more of an anxiety that you're seeing across the pond?
That's a great question. And, it's not something clients really bring up. I have to be honest, they're not bringing up regulation as their sort of main headwind. I think we're in a much more accommodative regulatory cycle than we've ever been before for crypto. And so the general tailwind is still there. And I think that has opened the doors for a lot more institutions to build over the last couple of years. And it is why we're seeing a lot more activity happening. Regulation is always going to be something that will influence how the markets develop and the type of activity that people engage in. But at the same time, I see very positive signs from the number of raises that have happened now with new funds on the VC side. I think those are some big numbers that have been coming through in the last few weeks. You saw A16Z's fifth fund come through, 2.2 billion. We saw Horn Ventures also. You mentioned you've got Dragonfly on in next week's episode, I think. So that's a pretty positive signal. We're not in a complete dead space. I think there's lots to be done. And I think it'll be interesting to see where that capital gets deployed and how it gets deployed.
Where do you think it'll get deployed first? We tried to ask Mike about this, and he was being a little bit coy. I think for obvious reasons, he's got skin in the game in many parts of the industry as well. But he said it's sort of a wait and see game. Do you have more of a high conviction response that any particular vertical, whether it's consumer or staking infrastructure providers, will see that capital touched first?
I think we're in this cycle that it's becoming more mature. So I think we'll see later stage deals being done potentially. And I think, there's more opportunity there. We've had this sort of almost 10 plus years of growth where we haven't really seen that many IPOs. So I think there's some of these later stage companies need to IPO. There sort of needs to be that then recycling of those assets back into the industry. Whether I don't know. I mean, I'd have to speak to the VCs more directly about whether they're planning to invest in early stage startups again, or whether it's going to be liquid allocation. I feel like there was less liquid allocation happening, and so maybe it will be back in liquid, or maybe it will be in these later stage opportunities where they're looking to kind of IPO.
Tough time to be a startup.
Yeah, I've worked with my fair few, and it's not easy. It's definitely the hardest gig out there.
Now, the way that you talked about regulation there, like you kind of like summed it up, and you weren't like looking at the little individual parts, but with like Clarity coming through looking pretty positive, and with Kevin Warsh looking like he's going to get confirmed as the new Fed chair, like. When these happen, like, are we looking at potential like big flush of more liquidity coming into crypto, or what are your views there?
Hard to say. I mean, I'm very much a wait and see kind of girl. I like to see how things play out and predict less what might come down the track. Like I said, I'm always more interested in what the 10-year yield is doing and what the market takes a view on. The premium and the risk premium they demand for their capital. And I think that tends to, be the bellwether that I personally am interested in.
It's interesting, like with the way that I would think that institutions would be like a little bit more like held back and like waiting for like, hey, the clarity's through, let's go, or we got Warsh in, let's go. But the way that they actually are is a little bit more like measured. So I like to hear that.
We've been hearing that more and more as well recently, right, TB, as we bring on guests to sort of paint the macro picture and how macro and crypto intersects. In the past, I guess a couple of years ago, you'd have experienced this as well, Harry. People would have said, this happens, these things are necessarily going to happen. There was this sort of causal relationship between a particular pivot point and their expectations. Whereas now I feel like, maybe to do with the maturity that you're describing, people are a lot more hesitant to say, yes, I think if something happens, there are going to be very serious consequences, i.e. massive liquidity flooding the market. I would like to hear from some of our institutional partners who are buying huge amounts of Sol and staking it. I would like to hear them with more confidence say things like, look, when the SEC regime changed, we had a very combative Gary Gensler in charge. There was massive amounts of optimism flooding the market. So it's maybe not unreasonable to expect that if Kevin Walsh does get confirmed in a very short period of time, we would see at least a bit of an uptick in liquidity. I think it would give retail participants like us, the degens out there, some much needed confidence. But curious to see when that's going to happen. Harriet, towards the end of our conversation, we also like to ask our guests a doomsday scenario question. We asked this to Matt Hogan not too long ago. I'm sure you're familiar with him, Bitwise's CIO, a great talker. We said, what's the worst thing that could possibly happen to crypto in the next 6 to 12 months? It's likely going to be around the Clarity Act or the midterms approaching. And he said, well, sort of both, but also neither. He said, imagine a scenario where the Democrats, led by someone like Elizabeth Warren, managed to gain substantive amounts of power, political power in the US, and they sort of start to chip away at some of this regulatory progress that we've made over the last 2 to 3 years. That would be a potentially doomsday scenario. I'm curious if you share that. Do you lose sleep over this? Is it something that gives you nightmares, or do you think more negatively about something else entirely?
I think that's a really interesting perspective, actually, and I think nothing kills confidence more than ambiguity. Markets like certainty, markets like to know facts, and I think we've been in this phase where there's been a little bit of a back and forth, and it's not been as clear for generally the market participants. And I think signals have become more blurry and less easy to read over the last 12 months or so, and I'm talking global macro again, and so I think all of that then does feed through naturally into then where we are. And so it's always been a case that the more clarity we get, the clearer the direction can be, whether it's up or down.
Clear. Now, we're going to move into a sort of a quick fire round, short answers, short and sweet as much as possible, up to 30 seconds. If you do want to elaborate on something, then of course, feel free to. We're going to start with one about staking, given that it is right in your wheelhouse. What's the biggest and most underrated staking opportunity that institutions are sleeping on, ignoring right now?
I would possibly say LSTs are really underutilized. I think there's a real opportunity there in terms of them being liquid collateral. And I think as more institutions become more confident and knowledgeable on what LSTs are, they'll start to utilize them more.
Yeah, I love LSTs myself. Now, I got a question for you. I watched a video of you explaining NFTs a while back. This was a few years ago. Are you still bullish on NFTs after all these years?
Was I bullish then?
Yes.
I think it's an interesting cycle that we've gone through, where the kind of read, write, own narrative has sort of become a bit more diluted, and I think we've seen a lot more of this Web 2 incumbents move into our space, and maybe with a slightly different approach to what the original Web3 proponents brought. And so I think we're kind of in some hybrid place. I don't think NFTs are necessarily done in terms of their technical implementation, what they can bring. I think the use cases, they were very immature, and I think they're sort of more like POCs, and the production use cases never happened at the scale that they needed to happen. So who knows if a large fan platform comes in, or the sports teams come back and they start to re-engage on this level, I think we could see a new wave of interest in NFTs. So I don't write them off. I think technically what they allow is really interesting, and the ownership component, whether it's something people care enough about or whether it's the Web2 incumbents find it useful enough to implement them, is another question.
Yeah, I like the community aspect of them still, almost like the country club effect. And speaking of that, one of the NFTs that you were talking about was the Link Golf NFT. And that was Mike Judas's project, right? Who we had on last week.
Yeah. Me and Mike talk golf every now and again, and we still haven't got out to have a round together, but you know, I'm a big fan, and yeah, I still have that one in my wallet. So, you know, I think there is a nice element of bringing people together through that shared ownership scheme.
Oh, that's fantastic. That's fantastic. Okay, one quick question for you. You said Web 2, Web 3. Are you calling it Web 3 or crypto these days?
I think it always depends on who you're talking to, right? So I think if I'm talking to a traditional institution and a bank, it's digital assets. It's none of the above. But you know, if I'm talking to my ex-consensus colleagues, then we're definitely talking crypto or Web3.
Oh, that sounds good. That sounds good. Jack, you want to jump in on one of these? Sorry, I don't
I've got some short questions for you as well here, Harriet. Privacy. Thomas just did a big investigation on privacy. Is it something huge, or is it overhyped?
I think it's something important for traditional institutions. To what degree it becomes important, and you know, I think there are sort of places where privacy is less important, but suddenly, you know, if you're thinking about a big bank and a trading floor and a trading desk, they don't want to be giving look through into their positions and their client allocations either to their competitors. So I think there's always going to be a need for privacy, whether there are solutions that can be built to kind of enable open and public permissionless access at the same time. I think that would probably be the sweet spot.
Interesting. So out of all the people that you talk to, us probably being on one end of the spectrum, who's really more degen? Is it TradFi or crypto natives?
I mean, crypto natives, I still enjoy talking to the people in the weeds, and you know, people using prediction markets day in, day out, and you know, I think it's a really interesting space, and it's where a lot of the innovation happened to begin with, and I'm really grateful for everything that's been built and has gone before today.
It's a unique space, right? All right, I got a question for you. So there's been some pushback from the Solana community on the inflation rate of Solana. Do you think that the inflation rate is too high on Solana, or is it just right the way it is?
I mean, it's very subjective. I think it's is it too high? I mean, I think it's an important part of the overall APY that has been generated, and I think if there, you know, to your point earlier, Ethereum has a significantly lower rate, and actually that has some challenges as well. It has some headwinds in terms of, you know, whether it makes sense to allocate to Ethereum for certain people in that environment, depending on what obviously their risk and kind of operational needs are. But I don't have much more review than that.
Sounds good. Sounds good. It was a tough one. All right, so where do you think retail should be spending their time right now in crypto? Because I feel like there's a lot of like big narratives right now, and they're tough to make money in, right? Perps are hard to beat. Memes are sometimes dead, sometimes alive. Stable coins are flat. You know, prediction markets are kind of hard unless you're really into the niches. Where should people be spending their time, right? Like, should you own the shovels and like the pump to get access to the memes, Sol to get access to stable coins, or like what? Like, where should people be paying attention right now, in your opinion?
It's a hard one. I don't know if I can give too much guidance on what retail should or shouldn't be doing. I think, you know, my approach to the space has always been stay curious, learn as much as you can, keep updated in what's happening, you know, see what investors are doing, how they're raising and where they're allocating, and that will signify, you know, the direction of travel for the industry in general. And I think the things that are becoming more important to the infrastructure that's being built. And I think the infrastructure for me has always been the most interesting space. So
yeah, I feel like there's so many different sections. So it's like whatever interests you, you should definitely check out, right? Okay, speaking of interest, what is your 10-second pitch to onboard my wife into crypto?
I think speak to you as a crypto degen yourself, and you can share the ropes. I'm scared to lose friends and family by introducing them to crypto, and I don't want to lose more friends and family than I have already, and be the black sheep of the family in terms of people asking what happened to their crypto. So
care if Michael Saylor sells a little bit of BTC here and there?
To the point I was making earlier, I don't think institutions care about price in that way. I think institutions think of it more as a long-term play, and so they care about the infrastructure and the technology that's been built and deployed. And so, the overall price of Bitcoin might be a signal, and of course, if Michael Saylor sells, it might be already priced in that might happen. But I definitely think institutions, in terms of how they're approaching the space, they care much more about what they can build as use cases on the technology rather than what the price of the individual assets are doing.
Clear. Now, I know you probably can't give a very clear response to this because of who you work for and the people that you work around. So we're going to put an NFA, do your own research disclaimer on this. And I know you probably can't talk too much about price, but Solana all-time high next. Is it happening before, during, or after 2027?
I'm going to take a pass on that one. I can't talk price. I can't talk price targets, nor do I want to. And also, you've been already pulling up reels from 2022 and 2020, and God knows, whenever else I spoke about different things. So, this one will come back and bite me. So
that
I'm
is
going to
fair.
pass on that.
That is fair. Once it's out there, it is there forever.
I was very passionate about it, for sure.
Yeah.
That's true. Now, Harriet Browning, this is exactly the conversation we needed. I think we are so focused on crypto Twitter and some of the negativity out there that we sometimes forget that the big picture is much more complex and worth talking about, and how much we've matured as an industry and how much the institutional capital is actually shaping it as well. So really, really appreciate your time here. It's been great chatting to you today. To our dear listeners, don't go anywhere. Very quickly, we are chatting with Haseeb Qureshi from Dragonfly next week, who returns to SolanaFloor with no doubt plenty of hot takes. Among many topics, we will be touching about where that $650 million is going to get deployed. Interesting amount of speculation coming out of that. Now, if you do follow Haseeb, you'll know that him and Mike Dudas have had plenty of heated exchanges, both on crypto Twitter and on stage at conferences. So that's another thread, a spicy thread that we'll be tugging on. With that, we have the Solana weekly recap happening tomorrow at 11 a.m. ET. So to all our listeners, see you tomorrow for the most important news recap of the week. And we'll also see you next week, Thursday, for the big picture with Haseeb. Thank you, Harriet. Thank you, Thomas.
Thank you very much, Harriet. We really appreciate it. Great talking.